So right now we've got a perfect example of the mistake that many, if not most, investors make, in that uh, they become emotional, or their decisions are emotionally driven. So the stock market has been in a major rally. I believe this is week 15, which means that this intermediate cycle is getting very mature. And if people could think logically, when you get late in an intermediate cycle, you want to be thinking about taking profits, not jumping on the rally, assuming that it's going to just continue forever. Um, what I've shown in some previous videos how this has played out in metals, where traders become very fearful of missing any more of the rally, and they end up buying at the top of the rally. And what people should be doing is, when a rally gets mature like this, this is where you want to be taking profits and looking for a market that has not started to rally yet. You want to find something that is in this position here and be buying. But what happens is when a market is correcting, people are fearful to pull the trigger. And when the market has rallied for a long period of time, for weeks and weeks, they become convinced that the rally is never going to end, or that they will be smart enough, quote unquote smart enough, to spot the top. It's not that easy to spot tops. So most people, if they get into this game of musical chairs, usually end up getting caught, and when the music stops, and then they end up riding the correction down. So I've shown this chart, and let me widen it just a little bit more so you can see what I'm talking about. All right, so this is the 200-day moving average, and you can see on this chart it becomes glaringly apparent that the market is stretched, I would say, obscenely far above this 200-day moving average. This should make people nervous, but the way most investors and traders think is they become more and more confident the longer this rally lasts. So instead of becoming more and more nervous, like a professional trader would be at this point, the unsophisticated, emotional type investor becomes more and more confident, and the fear of missing any more of the rally becomes the driving force. And so this is where these kind of people want to be buying rather than selling. And of course, if you're buying up here, you don't want to sell. You want this to keep going higher and higher and higher so that you can make a good profit. But late in an intermediate cycle, this is dangerous. What people should be doing is taking profits in this market and looking for a market that is ready to form an intermediate bottom and rally. And so, I've been pushing this for a while now, that gold is in an intermediate correction. And so the stock market is probably close to a top. Metals are almost certainly closer to a bottom. And then the problem that people have is, of course, they want to get out at the exact top of one market and get in at the exact bottom of the other market. And if they get out a little early, they have seller's remorse, and very often they'll jump back in, and then they get caught when the music stops. Or they get in a little bit early in the market that actually has potential, and then they take a drawdown, and they can't rationalize. The rationale is oh, I should have just stayed where I was at, instead of getting in this market that's never going to bottom. But that is exactly the wrong type of thinking, and it's way too short term of a view of the markets. The metals are going to bottom here. And there's even a small chance that they bottomed yesterday. I think in my last video I noted that they gold had finally retraced to the 38% Fibonacci level. That is my minimum requirement for an intermediate decline. So we've hit the minimum, and I covered in my last night's report for subscribers that most of the parameters have been met in the metals. There's only like one or two left, and it's not absolutely necessary that those last two parameters get met before the intermediate cycle bottom. So it's possible that gold formed a final intermediate cycle low here. I'm going to need to see a little bit more before I make that call, but metals are potentially at the spot where stocks were at back in March. So, if you can think logically, if you can take a longer term view of the market, you're better off at this point not to be chasing the stock market, but instead to be getting ready to get into position for the next market that is going to give us that multi-week run. And as I've explained before, I don't really think that is going to be in the energy market. I think energy is probably still going to be stuck churning sideways probably for several more months, maybe even the rest of the year. The market that I think is trending is the metals market. I think this is an 8-year cycle low right here. We've had a huge initial move off that 8-year cycle low, and now we're in really the first real corrective phase of that first initial thrust, and it's due to bottom any time now. And this is the market I think you want to be positioning into, and even if you're a little bit early and the stock market keeps going up, you need to ignore that, because as I showed, stocks are dangerous. They're stretched way too far above the 200-day moving average. The FOMO, fear of missing out, is very strong in the stock market, and sentiment is starting to get fairly sour in the metals. And so this is the market that is building the fuel for the next rally. The stock market is probably about to run out of fuel for any further move, and if you keep pressing your bet in the stock market, eventually you're going to get caught when the correction begins. So smart traders that are able to control their emotions, understand you want to be taking profits in stocks, and you want to be at least preparing to get into positions in the metals, because the metals are where the next trending move is going to be. It's where the risk is low and the reward over the next several months is high.